You want the most money for your block and the developer wants to get it for as cheap as possible. From plot to profit, we dig deep into a developer's desires and how you can go from lot to jackpot by outplaying them at their own game. That's coming up. A dilapidated old shack and thought, prime real estate right there. Welcome to the thrilling world of property development. It's where savvy developers see skyscrapers, townhouses, luxury condos, while the rest just see a dilapidated old shack. Well, not anymore. In this video, I'll show you exactly how you can get the price of a diamond for your dirt based on not what it is as is, but the gold mine it could become based on its development potential. So stay with me. With every second of this video, you'll uncover secrets about your property's true value. And I'll not only give you actionable steps, but I will also introduce you to a game-changing software that will empower you to negotiate like a pro and extract the maximum price for your property. You don't want to miss this. Feel free to pause and rewind and or bookmark this video. So here's how you can do it. The first thing that you must determine is what drives your property's value. When it comes to property, it's not just about four walls and a roof. There's a whole lot of factors that can drive your property's value through the roof. First up, location, location, location. A great neighborhood can be a game changer. Don't forget about the surrounding infrastructure and amenities, parks, schools, shopping centers, and the closer they are, the better value you can extract. Size matters too, and not just the size of the land, but for a developer, side frontage, that is, how wide the side is at the front, can play a big role. In essence, it makes it easier for the developer. And let's talk about zoning. Whether it's residential, commercial, or mixed use, as well as high and low density, can also entice a developer. A high density zoning means that the developer can put more lots on the same block, which further drives down the price of the land the developer has to pay for each unit, which for you is good news, as it directly translates to higher site value. So when you're looking at property, remember there's not just about what's inside the four walls, it's about the whole package. Market trends. In today's ever-changing real estate landscape, understanding market trends is the key to extracting more for your property. Knowing what's in demand, whether people are looking for 3-bedroom single homes or 4-bedroom townhouses, whether there is more demand for apartments, or would creating an office space will be best for the developer. Now, you need to know this because that's the information we will use in 1 Minute Feaso that will tell us exactly what your land is worth to the developer. Development potential. You want to figure out the development potential of your property. To knowing the total area, the total number of lots, plot ratio, FSR, floor space ratio, etc. is important so you can quickly punch in some numbers. Here's how you can determine your property's worth to the developer. First up, let's play detective with some comparative market analysis, or CMA, that's what I like to call it, by looking at recent sales history. What's selling at what price, what's the square meter or square feet rate for sales. You can uncover a lot of things by doing a quick search on finding out the historical sales data. But you don't have to stop here. You can also call in your local real estate agent and get a professional appraisal on what they think the site would be worth. But that's a good starting point. But is that how a developer does it? Look, so far we have gathered information. And if you have gathered all that information that we discussed earlier, here is the key moment you've been waiting for. Let's fill out this basic information based on certain assumptions and see the maximum value you can get for your property. Just quickly before we start filling out the information, this is what we've done so far. We've figured out what drives the property value, the side frontage, zoning things, and so on. We figured out the market trends, what's the demand, people looking for residential, commercial, mixed use, or if it's residential, under residential, is it higher density so we can put apartments or townhouses and so on. We figured out the development potential, like we figured out the total number of lots that we can put on the block of land. We figured out the methods, there are different methods, like we figured out the sales, that we've compared the market, we looked into historical sales and so on. And now it's action time. So now what we are doing is, the only thing that we haven't figured out as yet is the construction cost. And what I suggested you to do is, like, let's say you've got townhouses, and for townhouses we figured out that to build each townhouse it costs $400,000. Okay, so let's look at 1 Minute Feaso and how you can see exactly what you are going to make for each one of these. Now this is very, very simple, and we're assuming that we can now put 3 townhouses. Let's see what happens, and let's see what the impact of each one of these would be on the feasibility. So when you start off, you put in your symbols, your GST, if it's applicable to you. If it's not, you turn that off very quickly. If you're developing residential, that's fine. Different type of interest calculation. Now it is very easy. I mean, even if you don't know what each one of these is, just click on that and a video would pop up and it will play and show you exactly what to do with each one of them. But the key thing you need to know is that what sort of margin will you allow your developer to make based on your land value? That is, you are now making sure that they are not making too much, but they also are taking the risk. So based on the size of the project, based on what they will be developing, they would want a higher margin on the cost or lower margin on the cost, depending upon whether your site has a permit or it hasn't got a permit as yet, and all those things. So just based on the potential, and let's say the site doesn't have a permit, for a smaller development, 15% development margin is pretty good. It's pretty good. It's stock standard. And if it's even a smaller, like if you would go to a 2 townhouse development, this would even fall to by 10. And the higher you keep going, the more margin they would want, because obviously the developer's taking more risk. So let's move into units. We figured out that we can put 3 units. With our historical sales, we figured out that we can sell each unit for 950,000. Now we're not going with built area because we don't have any plans right now. So let's say you haven't got any plans. If you did have plans, you would select cost per unit of measurement instead of per unit. And that's why I've selected 1. That means I'm building 1 unit for 400,000, and I'm adding some contingency on it so that there's a bit of buffer, because all I have to do is pick up the phone, call a few agents or call a few construction contractors or builders working in the area who are building similar type of properties, to be able to get a feel of where a 3 townhouse development or a 3-bedroom townhouse or a 4-bedroom townhouse will cost me. Once you've done that, we go on to costs. And we figured out, okay, let's say the value of the land is 800,000 for the time being. If there is a stamp duty, you put those things. If there are any closing costs, you allow for. Now think of it as the developer still needs to do all those things that you are doing here. If the consultants, if there are consultants, if there are no consultants, you can allow in a detail. So if you hover over this, it'll give you that, okay, if you know the exact value, you can put it in the exact value, or you can allow, let's say 4% or 5% of the construction cost. Development contributions, it's like a development fee that the developer will need to pay the local council or local authorities. That's the fee that you will allow for here. Again, you can pick up the phone, call your council, find out what those fees are. You can do that so that you can reverse engineer and get the most for your land, because that is the whole point of this exercise. Closing costs, that is the agent. Developer will have to hire an agent to sell those units. And if there are any miscellaneous costs, which I'm leaving blank for the time being for this exercise purpose. Under finance, are they going to just buy the land and there would be some land costs involved, or would they go straight into construction? Now there is a lot of room here to play with, but you still have to make certain assumptions to be able to see what you can get for the block of land. And the more real they are, the more money you'll be able to extract from the developer. So in this scenario, we're just going with total cost, and we are going 65% of the total construction cost, loan setup fees, loan draw. You can figure out what these things are, but I quickly want to show you what it actually looks like. So in summary, it figured what the main thing that you must know or understand is this part here, where the residual value of land, which is the most important thing to know. And the way this residual value of land works is that we've got 15% as the hurdle rate that we put in. This is the margin that we allow the developer to make. And then we've got this part here, which is the maximum value that you can extract for the land. You might have started off, for example, under settings. If you go here under cost, we said our land was worth 800,000 and you figured it out. But then you also figured out that, hey, I can put 3 units on it. And based on the 3 units, the land value is going to be more based on these assumptions that you can, if you can get 3 units, you know what you can build them for, you know what you can sell them for, you can easily figure out what is that going to be. Now I did three of these so that I can quickly wrap up this video, and no one's getting bored, and you can sign up below and go with it. And with each one of them, what we did was we figured that, okay, 3 townhouses, what can I get for this? For 4 townhouses, what can I get? If the developer can get 4 townhouses on my block, what can I get there? If the developer can get 5 townhouses on the block, what can I get in that scenario? And in all this scenario, I know that my starting value is about 800k, but what we are playing around with is this part here, which is the residual value of land for each one of these scenarios, where I say, hey, this is a stock standard development, we can easily give 15%. Developer is happy to make 50% on this thing, and based on the 15%, my value for this block should be 929,000. That means that if instead of paying you 800,000 here, and the developer can still afford to pay you 900,000 and still make 15%. That's what it actually means. Let me rephrase the whole thing again. So what this basically means is that you think your value of the land is 800,000. But what I'm saying is that based on this calculation, based on the assumptions that you have made, that you can put 3 townhouses and the cost for selling them, or the cost for making them, and what you can sell them for, the developer can still make 15% if they are paying you 929,000. So that means they can still make a good profit per unit. And you'll see that there is profit here. There's 467,000 for them, which is good money. But you are now keep getting $129,000 more than what you were getting earlier. The same goes with here. If your townhouse development, instead of 3, now you can put 4. If you scroll down and see, the developer could argue that, hey, this is a bigger development, I have to borrow more risk. What you do is you change the hurdle rate. And based on 20%, the developer is still making 20% on the cost. They can still afford to pay you 1.1 million for this block of land. But obviously now you're maximizing the site even more. You're getting, instead of 3 townhouses, you're getting 4 townhouses. And you start off with 800, doesn't matter, but they can still make that. Yeah, they're still making 929,000 here. Now, if I go and change this value to 1.15 million. So now this is a 4 townhouse one. So let's go in here and go back into applications, 1 Minute Feaso, go into the 4 townhouse one. And over here, what I wish to do is, let's see, on our summary, 1.15 million. Let's go to our settings, cost. Let's change the value of the land to 115 million. So instead of now the developer in this feasibility, now the developer is paying 1.15 million instead of 800,000. So if you go into summary, you'll see that the developer is still making 548,000 even when they are paying 1.15 million for the block of land, which is very close to the 20% margin that we put in as a hurdle, because I didn't put the exact number. So this gets very close because this is iterative. It goes into a loop. It just goes crazy. It keeps calculating the interest, and then we do it 10,000 times and come up with the most probable number for you. So all this is done in the background for you, and you have no headache. This feasibility, once you wrap your head around this thing, you can do these numbers in less than 1 minute, and that's why it's called the 1 Minute Feaso. Arm yourself with 1 Minute Feaso, dive in and discover the true worth of your property to make sure that you do not leave a single dollar on the table. Trust me, if you know what the developer will do with your site, once they own it, you can literally extract every last penny from the developer for your land. Don't get taken for a ride. Click the link in description and sign up for 1 Minute Feaso today.